Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, March 14th, 2018. I had a request in the trading room from a new member of the site for an update on gold, the gold mining stocks, the US dollar. For those of you who followed me for a while, you've probably heard me say many times that in my opinion, any analysis on gold is incomplete without analysis on the US dollar because of the effect it has. And this is what we're starting out here with. It's a 10-year weekly chart of using the ETF's UUP, which is the US dollar index tracking ETN, and gold GLD. And as you can see here, this chart might not be clear at all, but basically you can highlight the inverse correlate or see the inverse correlation here. When the dollar falls, gold goes up, and that's because as a dollar depreciates, it takes more dollars to buy gold. Of course, GLD, the ETF, is priced in US dollars. So it's gold per ounce priced in US dollars. And likewise, when here you can see that down here, the US dollar again in black bottomed, and that's when gold topped. So the correlation is pretty clear, especially over time. Now, I will say this, there are, as with just about any two asset classes that have any type of correlation, there are some temporary disconnects, but for the most part, you can see it pretty clear. And if I do this, if I type in UDN, UDN is the inverse US dollar index ETN. So that will show you that then gives you the positive correlation. So you can see as gold is going up, so is UDN, meaning the dollar is falling, and vice versa. So there it is, pretty clear correlation between the two. You can see most recently back in late 2016, there's the advance. So you can see the major tops and bottoms in there. So now with that being said, let's start this video out with a look at the dollar, because I'll say this, my convictions on where the dollar is headed, at least longer term, is a little bit stronger right now than my convictions on gold. So let's go ahead and take a look here. Now this is a chart 20 plus years. I think this one goes back about 21 years of the US dollar index. It's an end of day chart, doesn't reflect today's trading yet, but what I'm looking at here is a bigger picture. Up top, you can see this is the RSI. You can see all the overbought readings, divergent highs. The red arrows show all the corrections that came after those overbought readings. Back here, we had the most overbought or the most extreme overbought readings in decades in the US dollar index. And of course, that was followed by, I don't have the red arrow drawn there, but you can see we did correct from that point. And that actually terminated in so far, a divergent high. So in other words, we pushed back up. The RSI made another overbought reading, but it was a lower high, just like we had negative divergence back here that preceded these corrections, this very large drop here, negative divergence right there. So you can see all the divergent highs marked as well. So as I often say, overbought in itself is not a sell signal, at least not a timing indicator. Sometimes you do get these one and done overbought readings like you had here, but when you can get divergence, especially large divergence like this, that tells you a big move is coming, and it did. This was the largest drop that we've had in years in the dollar. You can see going all the way back to, oh goodness, I guess all the way back to 2011, 2010. In other words, that divergence looks to have played out at least for the time being. And what I'm looking at now, fast forward to today, is positive divergence. You can see it down here on the PPO. You can see, let me clear these arrows out, as the dollar just recently had this thrust up here, made a new low, and that's very steep, very sharp positive or bullish divergence there, both on the RSI as well as the PPO. Not only that, but the US dollar is also at support. You can see when we go back to the left of the chart, back in 2010, we had a reaction high here. We had two highs here back around late 2008, early 2009. There were a few reactions here along the way. So a pretty decent support level. And as such, to make it clear, I do favor a reversal, a meaningful bounce in the dollar from here. Now, on face value, that would be, and it may be bearish for gold if this does play out. So let's just say that's not a very large divergent low, but it should play out for at least a move back up here to that resistance line around the 90, just over 92, around $93 area. So looking for, in the coming weeks to months, I'd be looking for some more upside in the dollar. We've had a little bit, you can see it already caught support here and it started to bounce. And that could put, or at least give gold some additional headwinds. Now, a minute ago, I talked about how the correlation between the dollar and gold, sometimes there's a temporary disconnect. Well, gold is also a flight to safety asset. So if things get really ugly in the market, of course, that gives gold a tailwind. People will often flock in, institutions will flock to gold for safety. But we don't know what the market's going to do for sure. We don't know what gold's going to do, but the best thing I can do is take a look at the dollar and try to align my analysis with gold. And some of the best trades are when you can align a bullish case in gold with a bullish outlook or I should say, a bearish outlook in the US dollar, and vice versa. So if you want to short gold, you need to make a bearish case there, and you need to make a bullish case in the dollar. So right now, intermediate term, I'm looking at what seems to be a bullish case in the US dollar, with the dollar rising, which could put some, like I said, give some headwinds to gold. Even if the market corrects, then you might not get as much of a bid in gold, a rise in gold as you might normally if the dollar was falling at the same time. Okay, zooming down to a daily time frame on the US dollar index. These are US dollar index futures, and you can see this is that same level I was looking at on the weekly chart. You may have noticed on the weekly chart, you'd have to go back away. Below that, if this level happens to give way, let's just say those divergences that I pointed out on the weekly time frame do not play out. If the dollar continues lower, well, number one, that would be bullish for gold. And the dollar index is still in a downtrend. You can see the downtrend line here. We don't really have much, if any, decent evidence of reversal yet. So I basically have divergence at support. Here's the daily chart. I have a MACD on there and an RSI. You can see some divergence as the dollar falls to that support level. But I did want to make mention, if that level goes, sometimes divergences don't play out. Like I always say, divergences aren't a standalone buy or sell signal. They're just an indication of a likely trend reversal. What you need is some type of candlestick reversal pattern, trend line break, something to trigger a buy signal. So that's what I'm on watch for here. And if you zoom in, well, before we zoom in, you can see if the dollar does take out this support level here, let's call it 88, then it's probably coming down to about this 84, I'll call it 84 to 84.50-ish level. And as we zoom in here, this is the downtrend line that I'm watching right now in the dollar index. So there it is. Trend indicator here is still at least the MACD is below the zero line. So my convictions aren't super strong on if and when this will break out, but we'll continue to narrow down to the charts here. Look at the euro real quick, the euro US dollar pair, and then we'll wrap it up with gold and GDX. Okay, now to further add to my longer term case for a meaningful rally in the dollar, which again will give headwinds to a trade in gold, would be the euro US dollar pair. Now, the euro is by far the largest component of the US dollar index, counts for well over half of the US dollar index. So I'll often use this as a proxy for charting the dollar. And what stands out to me, I'll color code these lines for you, is this large rising wedge. Now it's not by mere coincidence. You had a downtrend line that I just showed you on the dollar index, and on the euro US dollar pair you have an uptrend line. This is really looking at the dollar in reverse. When the euro is rising against when this chart is going up or the euro is rising, the US dollar is falling. So the euro has been climbing against the dollar, meaning the dollar's been in a downtrend. And so what you want to watch is this trend line break. It's pretty well defined. And as you can see, we had a divergent high right here at this point. We had a divergent high here. There was a correction. That was my final target zone was hit almost to the button right there at the top of that target zone. And then we reversed. And so where I'm a little uncertain and where I'm leaning towards is another thrust up here in this, meaning euro up, dollar down, and that should help gold in the near term. So I'll just make that clear that if I'm near term bullish in gold, leaning towards that. Near term bearish in the dollar. I favor another thrust up. In doing so, we did have a divergent high here, but that would put in that third. And I often say, three strikes and you're out. When it comes to consecutive divergences, it's pretty common, or I should say uncommon, to see more than three consecutive divergence. In other words, this was divergent high number one, divergent high number two. Each of those were followed by corrections. And if we make a new high in the euro US dollar pair, if you can, as you can see here, I've drawn with these purple lines, it'll almost certainly be a divergent high if it happens relatively soon. And that might be one place to put on a short for the euro or long, go long the dollar. And of course, once you break this trend line, as well as that, keep an eye on the dollar chart that I just showed you, dollar futures. You want to see both of those align, and this would be your first target here. There was a pretty well-defined support level. So this is the, near term and longer to intermediate term outlook for the U.S. dollar as well as the euro and how that plays into gold. Okay, and we're stepping it down again. We started with a weekly time frame going back, over 20 years. Then we were on a daily time frame just a second ago, looking at the euro US dollar pair as well as the US dollar index before that. And now this is a 60-minute chart. So this is the nitty gritty where I try to really hone down and time my entries and exits for swing trades. You can see this level marked here, 1.23475, give or take. Currencies trade out to the fifth decimal. So it's a pretty decent support level. And given this is only a 60-minute chart, so it only goes back a couple months here, but you can see quite a few reactions off this level in the past. It's capped a lot of the advances back here in February and early March. Then we had a breakout. That breakout, we stayed above it for a while and then fell back below it with an impulsive move. We tested it from below. So although we've traded above and below that level, there's a lot of reactions to help validate that as a significant technical level in the pair. So if that level goes, this is the next support level I have down here around the 120, between almost 123, a little bit under that. But so far the support level has held. You can see we just recently tested it here and we moved higher. This 60-minute trend indicator, I like when the PPO, I like to use this 9 EMA, which is the white line. When that's above this zero line right here, the dotted line, the trend is bullish. You can see we had a bullish cross here. We had a bearish cross here, bullish. So you can see it does a pretty good job on most securities, not all. If I look at a different security, I use the same PPO indicator as a trend indicator on the broad markets, the US stock markets, which have really nothing to do with the euro US dollar pair, but it tends to work well. But as with any indicator, if I'm looking at a particular stock or index or a commodity and I see the 9 EMA just slicing through like it wasn't there, slicing through the zero line that is, I'll disregard it. But as of now, that tells me, and I can see the PPO curling up here. So I do favor, especially as long as this support level holds, that's my near-term outlook, which again is euro up, dollar down, which should equate to a rally in gold here, at least maybe a tradable rally. And let's take a look at one more. Actually, we'll jump on over to gold now and get into gold and GDX, and we'll wrap this up. This is gold on a daily time frame. Uh, all these divergent highs and lows and corrections have all been highlighted in the past. Most recently, we had a pretty well-defined uptrend line and a sharp advance in gold that culminated with a divergent high. You can see the big negative divergences here, just as we had negative divergences back here. We had actually a series of three divergent highs. There's that, third strike and you're out, as I like to say, with three consecutive divergent highs. That ended in that final correction. And again, you can see gold trades pretty well to trend lines, and that's what I'm looking at here. So it was, highlighted here. And then we had divergences building up to this point, and we did get a correction. We had a kickback rally. It fell shy of those highs and another pullback. But the bottom line is gold has been grinding, and I mentioned that too when I closed out, my gold longs. I closed them a little early and then looked for a short, got a, quick pullback trade there on the miners. I usually trade the miners as my proxy. You get a little more bang for your buck when trading GDX or individual mining stocks versus gold. But you can see it so far it's held. This was a pretty significant level. I think I highlighted that a few weeks back, 123.25. We came down, almost kissed that level and reversed. And you have some minor support levels here. So the bigger picture, and the reason I haven't, posted a lot of analysis recently, is this choppy sideways trading action. That's what I try to do a good job of, is sidestepping any particular trading vehicle, asset, commodity, stock when I think there is going to be a lot of sideways grinding, and that's been the case with gold. So that's why I haven't posted a lot of analysis until the request today. So there it is. But again, so I can't make a screaming case to go long here just based on the charts of gold alone. The trend is still bullish for now. You can see when we look down below, I have the PPO. You can see it starting. It looks like it's curling right back up on the zero line. And again, that's done a good job. You can see the red arrow. That's when the PPO, the trend indicator, crossed. And you just look at, you can freeze this chart if you want and look at gold, the price of gold, what happened every time we had a crossover there. Again, use the white line. It's done a really good job of defining the trends. And as the white arrows show, it often acts as support when tested from above. So that's what's going on right now. We have a back test from that trend indicator. And we had a pretty big divergent high, and it may or may not have played out. I think it has in both price and time. I always say that stocks can correct, or securities, any asset like gold, can correct in one of two ways or a combination thereof, both price, by meaning sideways grinding trading action, or I should say, yeah, in time or in price is what I meant to say there. And with gold, we've seen to have done both so far, and in my opinion, to at least satisfy this correction. So there's a good chance it could be over for the very near term I'm talking about. Okay, and here's a 60-minute chart. This chart was posted, I was tracking this back in January and February. We had a divergent high there, a little correction. We broke down, we pushed back up, back tested really this trend line here, the divergence line, and put in a second divergent high, and there it is again. So this is what I'm referring to as a correction, both in price, but as much as time. Really, it's been since the January highs, really late January, and we've just moved down to slightly down to mostly sideways. Okay, and then finally we'll wrap up with GDX here. As I often say, this is my preferred trading proxy because GDX, or the gold mining stocks, are effectively a leveraged play on gold, meaning when the price of gold goes up 10%, most of these stocks will rally 20%, for example. And likewise, if gold drops 10, 20%, they're going to drop 20, 40%. GDX, now GDX has a very well-defined support level, and I've highlighted this in recent videos and analysis. We've had a lot of reactions here around the $21 level. This one fell a little bit shy. We've had two recent tags, and I've made mention in recent weeks that anybody looking to scale into GDX, it would certainly be an objective area to go long on pullbacks down to around the 21 area, with a stop somewhat below, ideally on a closing basis, even maybe a weekly closing basis. But that's GDX. So GDX is close to support. So, as long as that 21-ish level holds, maybe at worst case scenario, you continue to grind sideways for a while. Again, I want to make clear, I don't see a screaming buy right now in the mining stocks. I don't see the clear setups that I like. I like to see clean breakouts, well-defined trend lines, other type of buy signals, and the charts really aren't setting up for that right now. I have a little bit more clarity on where the dollar is heading than I do where GDX and gold are heading. But again, near-term bias is bullish, and longer-term bias is bearish right now on the mining stocks. Let's take a look. We'll go down and see if there's anything on 60-minute chart, and then I think we can wrap this up. No, nothing. See, again, sloppy sideways action, and this is what I really, strive to do in my own trading as well as on the site with official trade ideas. I highlighted this divergent low back here, made mention going long the gold mining stocks, divergent high there, divergent high two, divergent high number three. Like I say, lights out. And then we added gold, or GDX, I should say, as an official trade. You can see T1 was hit right here. First target was hit. T2 was hit, which was a final target. And like a lot of trade ideas on the site, we hit that final target, and very often that's where the trend stops. So we were able to time that one very nice, get in near, not too far off the lows, and exit at the highs, and then sidestep this mess. And that's when I say mess, I'm talking to just very sloppy chart action. But when we zero down to this time frame here, the 60-minute time frame, if you're looking to trade a short term, at least a short term, maybe even enter for a longer term trade, this level here, right about where we're pushing up now, around 2180. Seems to be a pretty good resistance level. I see a lot of reactions there. In fact, I've had that line there for a while. There were reactions back here. So if we take that out, and I'm sure you guys want price targets. This is a target zone right here. This will be my first target zone. It runs from the actual resistance lines I have are at 22.23 and 22.32. So that would be the first target zone. And if that's taken out, then we probably come on up and hit that next target zone, which I had that previous target set at before. So we'll call it around 23. At this point in time, I can't make a case, a solid case to go long for more than anything for a quick bounce up here. On GDX, that'd be about 2%. So triple that if you're trading GDX, the leveraged, I should say Nugget NUGT, the three-time leveraged ETF, so maybe 6%. And as always, you can either get out there if you're an active trader to not risk giving any give backs on your profits, or if you do go long, if you might want to wait for a breakout here, wait for a little more upside today, go long, and then set a trailing stop. Or once the trade starts to pan out, set your stop at break even, so you can guarantee at least a break even or a small profit. It's up to you. There's a dozen ways to trade. You can trail stops up, you can set stops at break even, you can ratchet those stops up manually as the trade goes. And again, if I could make a screaming case to go long GDX, it would be an active trade on the site, and I can't do that right now. So hopefully this analysis helps. And if the charts start to firm up and I see either a long or a short trade, if you've followed this site long enough, you know I am just as comfortable shorting any security as I am going long. But right now I don't see really a solid reason to short GDX. And if I had to do one of the two, at least for the next couple weeks here, I'd be long. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.